Please pay attention to your actions right now, because if you or a relative depend on any Social Security distributions, the details I am providing could directly alter the specific amounts hitting your financial accounts shortly. Currently, the administration utilizes an automated background framework that consistently verifies balance records. This does not happen haphazardly or occasionally. Right at the beginning of each monthly cycle, they retrieve financial records regarding specific beneficiaries. If their systems flag an anomaly, a formal notification is dispatched, which might lead to lower distributions or, alternatively, a temporary freeze on payouts. The tragic reality is that the vast majority of individuals experiencing this disruption had absolutely no intention of violating rules. Therefore, my goal today is to explain exactly what factors the agency monitors, the precise methodology they utilize, including the highly specialized tracking architecture that rarely gets public attention, and which beneficiaries face the highest exposure. By the conclusion of this discussion, you will identify the precise institutional database utilized for these checks, the core distinctions between individuals selected for audits versus those skipped, the exact asset thresholds that trigger a suspension of your support, the operational nature of hidden asset discovery sweeps, how your balances might legally serve as proof of physical recovery if you collect disability, and the immediate protocols to execute if you face an inquiry. These 6 critical areas are broken down clearly. Let us begin. Allow me to clarify a massive misconception that remains largely distorted across online platforms. The agency does not verify your banking history via manual efforts, like an employee sitting at a desk making phone calls to major commercial firms regarding your holdings. Rather, they operate a completely centralized electronic data interface. It is formally designated as the Access to Financial Institutions Framework, abbreviated as AFI. The mechanism functions through a direct pipeline where commercial institutions automatically upload information into the federal repository, completely independent of individual data requests. The administration possesses explicit statutory permissions delivered via legislative acts to monitor these records, ensuring strict adherence to baseline criteria and protecting public resource allocations. The AFI platform represents the technical vehicle enabling this broad screening capability. Consequently, whenever the agency requires verification regarding balance shifts, incoming cash transfers, or instances where you exceed an established financial ceiling, they bypass the traditional mailing process. They pull the electronic files instantly. Furthermore, there is an additional layer to this setup that remains hidden from the public eye. The Bureau frequently runs protocols known as undisclosed account searches. These represent localized sweeps tracking your residential coordinates, engineered to expose unlisted financial holdings. If an individual receiving SSI establishes an alternative repository without declaring its existence, the system is optimized to identify it. My intention is not to cause panic. Rather, obtaining an accurate understanding of these regulatory mechanisms positions you to maintain perfect structural compliance. You are likely asking yourself if these parameters apply across every single category of benefit. The direct response is negative. Let us differentiate the specific populations facing the highest relative vulnerabilities. Beneficiaries generally fall into 3 separate classifications, and their records are handled under completely different intensities during asset checks. Let us evaluate every individual group. Classification number 1 involves SSI beneficiaries. This segment experiences the highest frequency of automated repository audits. SSI represents Supplemental Security Income, a needs-based public resource created for individuals experiencing severely restricted income models and minimal material holdings. It serves as a financial fallback for citizens lacking the required employment longevity to qualify for standard insurance protections. Because of its structural dependence on financial need, the administration must continuously confirm that your economic reality warrants continued aid. That requires regular validation of your ledger balances, aggregated material net worth, and incoming funds. If you utilize SSI, this represents your baseline operating environment. Classification number 2 covers SSDI beneficiaries. This acronym represents Social Security Disability Insurance, which is the foundational program most citizens envision regarding physical impairment protection. To secure SSDI, your background must include active workforce contributions over a duration sufficient to accumulate necessary employment credits. This is an earned entitlement rather than public assistance. Yet, SSDI participants still face routine investigations. The agency coordinates regular assessments known as Continuing Disability Reviews or CDRs. These represent structural audits occurring on timelines dictated by your individual medical profile, where authorities weigh whether you still meet the benchmark impairment criteria. If they notice transactional patterns suggesting unreported active labor or external compensation, it can instantly accelerate the depth of the audit. Classification number 3 comprises retirement beneficiaries. The encouraging news here is that if you draw standard age-based retirement funds, the Bureau typically skips routine bank tracking. Your baseline allocation is determined by historical employment contributions, completely separate from your current accumulated net worth. Nevertheless, we must acknowledge an important exception. If you remain below the designated full retirement threshold while actively generating supplemental income, strict earnings ceilings apply. For the current period, that cap stands at $22,320 annually. Exceeding that benchmark means for every $2 generated past the ceiling, $1 is temporarily withheld from your distributions. If the system detects discrepancies indicating your actual earnings surpass your declared amounts, they will review your banking records. The positive aspect is that this specific withholding is temporary. Upon reaching full retirement age, the Bureau recalculates your baseline and returns the withheld allocations via increased monthly distributions going forward. However, attempting to obscure incoming revenue is a major structural hazard, not a viable plan. For those utilizing SSI, please focus intensely on the upcoming breakdown because the metrics become incredibly precise and impactful. The strict resource threshold, which encapsulates the absolute maximum value of your reportable liquid assets, is capped at $2,000 for single filers and $3,000 for married couples. $2,000 is a metric that has lacked meaningful adjustment for decades, yet it serves as the ultimate barrier protecting your allocations. A widespread error involves assuming resources only apply to primary checking accounts. In reality, the Bureau tallies every single accessible instrument, including conventional savings accounts, money market vehicles, certificates of deposit, and even reloadable prepaid cards. This final category often catches individuals completely unprepared. Many SSI recipients rely heavily on prepaid instruments because they bypass mainstream commercial setups or utilize options managed by relatives, operating under the false assumption that these assets remain invisible. They do not. If you possess transactional capability over those funds, the administration registers them as part of your resource total. Therefore, when tracking your aggregate material holdings monthly, you must calculate every asset, every active card, and every single liquid dollar. Now, we must analyze a topic that creates even greater confusion than prepaid instruments, often involving immediate family members. Consider this specific scenario. Your child transfers $300 to assist with elevated utility costs. Your local spiritual organization aggregates funds to support you through an economically difficult stretch, or a relative provides physical cash out of personal care. These actions do not constitute deception. They reflect family support. Unfortunately, under strict SSI regulations, personal gifts are classified as unearned income during the exact month they arrive. That is the operational law. Unearned income completely offsets your SSI distribution dollar for dollar during that specific cycle. Furthermore, if that transferred capital remains inside your ledger past the final calendar day of that month, it transitions from incoming revenue into an active resource, directly applying against your $2,000 ceiling. As a result, a supportive financial transfer from a relative can inadvertently breach your asset limit and trigger an automated reduction. The absolute linchpin here is transparent communication. Beneficiaries bear the legal obligation to report financial fluctuations to the administration. The majority of individuals remain unaware of this requirement and skip it entirely. With the AFI network operating every single month, the variance between reported metrics and actual bank statements continues to vanish. Official reports indicate that approximately $26 billion in historical overpayments remain uncollected from individuals who received excess distributions. This rarely stems from malicious intent, but rather from unrecorded revenue, undeclared holdings, or simple mathematical oversights that compound over long periods. When the Bureau identifies the discrepancy, they demand full financial restitution. Do not fall into that category. Transitioning to another subtle structural hazard, shared financial accounts represent a very frequent trap for SSI recipients. A significant portion of individuals maintain mutual access to ledgers alongside relatives, such as a romantic partner, an adult child managing household expenses, or a sibling tracking transactions. This is completely logical and normal in daily life. The underlying problem is that the moment the agency identifies your legal name attached to a financial repository, their default position is to attribute the complete balance exclusively to you. Not a percentage, but the absolute total. Imagine a scenario where your child links your name to their personal account so you can assist with joint household payments, and that repository holds $4,000. From an administrative viewpoint, you possess $4,000 in active resources, placing you $2,000 past the limit. Your SSI eligibility is paused immediately. You possess the right to contest this finding. You can submit supporting documentation, authenticated statements, and historical ledger records proving the capital belongs to someone else, and the agency maintains a formal process to evaluate those disputes. However, the resolution demands administrative effort and time. In the interim, you face the reality of an interrupted or frozen check while the bureaucracy reviews the evidence. The cleanest approach is to review exactly which active repositories bear your signature right now and evaluate the total balances within them. This has nothing to do with deceptive practices. It is about recognizing how the agency views your economic profile and ensuring that profile reflects reality. Let us examine another tactic the Bureau applies to financial ledgers that caught me completely off guard when I initially uncovered it. If you draw insurance-based disability tracking due to your employment background, you might assume your private banking records are entirely your own business, especially if your physical condition remains unchanged. Lately, during periodic medical audits, the Bureau has integrated financial balance tracking as a diagnostic metric for physical recovery. Look at the logic from their perspective. If your physical limitations genuinely prevent workforce participation, your revenue inputs should theoretically remain fixed and highly restricted. However, if your ledger suddenly registers recurring deposits originating from an unlisted commercial source, it creates an immediate administrative flag. They will investigate the source of that capital. Does it indicate active employment, an independent venture, or side labor that skipped reporting? Your ledger essentially turns into evidence highlighting your real-world functional capacity. The Bureau operates on the premise that if you can generate revenue, you possess the capacity to work. And if you can work, you may no longer meet the baseline legal definition of disabled. This does not imply that every random deposit results in an immediate loss of disability benefits. It does mean, however, that financial transactions and your medical eligibility status are far more intertwined than standard public perception suggests, and the administration cross-references both data points. This is why for SSDI recipients, monitoring what gets logged is both an economic priority and a medical protection priority. Let us map out the exact sequence to execute if you find yourself facing one of these challenges. If a formal agency communication arrives regarding your accounts, whether it constitutes an information mandate, an overpayment collection notice, or a structural adjustment to your payouts, follow this blueprint. Phase 1. Never ignore the correspondence. It seems comforting to put it aside, hoping the issue clears up independently, but it will not. Every passing day reduces your available recourse options. Phase 2. Analyze the text thoroughly. The Bureau is legally bound to articulate the exact discrepancies under review, the specific timeframes in question, and the precise items they require from you. Pinpoint the exact issue flagged before initiating any response. Phase 3. Organize your verification records, including bank statements, deposit details, and written documentation explaining the origin of any funds. If a relative provided financial assistance, record the date, the amount, and confirm if it was converted before the month concluded. Physical documentation is your shield. Phase 4. Deliver your reply inside the designated timeline. Most official notices mandate a feedback window, typically spanning 10 to 30 days. Missing that window forfeits critical procedural rights. If you require additional time, submit a formal written request for a deadline extension to keep your file active. Phase 5. If you dispute the finding, initiate an appeal. You retain the right to request a formal reconsideration. If that initial step fails, you have the statutory right to present your case before an administrative law judge. The first agency ruling does not represent the definitive end of the road. Phase 6. Inquire about an overpayment waiver. If the financial discrepancy occurred due to an administrative oversight or despite your accurate reporting, you can apply for a waiver, requesting the government to dissolve the balance entirely. Citizens regularly secure these approvals, but the process requires you to initiate the request. The regulatory framework is dense, but it contains built-in consumer protections. You simply have to engage the system. Let us synthesize emphasize the core takeaways. The administration utilizes the access to financial institutions architecture to automate the tracking of banking records, streaming data directly from commercial repositories into the federal framework. They also execute undisclosed account searches to uncover unrecorded ledgers. These scans occur monthly on the first day of the cycle for specific benefit models. SSI recipients occupy the top tier for tracking frequency because that specific program remains entirely needs-based. SSDI beneficiaries navigate intermittent reviews through the continuing disability review mechanism. Retirement beneficiaries generally avoid these checks unless indicators suggest they are concealing active workforce income. The $2,000 resource ceiling for SSI is the absolute dividing line. Breach that limit via checking accounts, savings vehicles, or prepaid debit instruments, and your funding faces suspension. Material gifts register as income during the month they are delivered, and if they persist past the final day of that cycle, they transform into active resources. You are legally required to declare them. Shared banking instruments are viewed as if the entire balance belongs to the beneficiary. Exercise extreme caution regarding which accounts bear your legal signature. Transactional velocity can serve as evidence of physical recovery for those on disability, meaning financial activity and health status are fundamentally linked in ways citizens rarely foresee. If a notification lands in your mailbox, act immediately. Maintain an exhaustive paper trail, contest unfavorable rulings, and request a debt waiver if the mistake originated outside your control. My final message to you is this: none of this information is shared to make you feel watched or to imply you are doing something improper. The reality is that the vast majority of citizens navigating bank reviews are not attempting fraud. They are regular people who were never taught the rules because the instructions were never clearly explained. That dynamic shifts today. You now hold a more advanced understanding of this structural system than the majority of Social Security recipients, and that comprehension serves as your protection. If this breakdown brought clarity, use the endorsement option. It takes a brief moment and ensures this insight surfaces for others facing the same challenges. If you have friends or family relying on SSI or disability tracking, pass this breakdown along. Silently providing the correct details to a loved one might represent the most impactful support you offer them this week. Additionally, choose to follow this channel if you want continued access to straightforward, transparent analysis regarding Social Security, Medicare, and broader benefit updates. I will see you in the next analysis.